Hello, everybody. Welcome back to Built for Life, Not Just Wealth. My name is Ryan Burklo, and on today's episode, we're going to be talking about taxes in retirement. When we look at taxes in retirement, I hear a myth out there often where it says that I'm going to be in a lower tax bracket in retirement. And my question back to them is always lower than what? And so sometimes that statement is accurate, and sometimes the statement may not be accurate. And so we're going to go through an example today around taxes in retirement and why that may or may not be true, and how you should look at where you're putting money today so that you can have the life that you want in the future. Because here's the thing, like, the only reason we're saving money again is to turn on that income stream so that we can spend our time where we want. And we care about the after tax version of that. And so most people that we sit down with, they've been so focused on the accumulation side, growing their wealth, and really almost no one plans for the distribution sequencing or the distribution plan when they get there. Like, ask yourself this question: what's going to be your plan when you turn on the income stream in retirement? And then secondly, what will be the tax bill? Meaning, not to get the exact number of what you owe in taxes, but how will your income be taxed, right? The IRS doesn't give refunds for poor planning, and that's the whole point of today. So when we look at, we're going to go through a couple of examples around taxation, and I want the takeaway will be for you to look at where you've been putting money, or if you're close to retirement, where your assets currently are, and what are the tax implications of that. So without further ado, let's dive right in. So I'm going to share my screen. So for those of you who are listening in your car or on your run or walk, make sure you check out the websites where we will have the video up. And again, that website is builtforlife.notjustwealth.com. So first and foremost, I'm going to share my screen here. We're looking at a client, and the client makes $400,000 a year of income, household income, that is. They've got $1.2 million sitting in pre-tax retirement accounts, $500,000 in investments, and $75,000 in savings. So when we look at their balance sheet, like, they're doing rather well. This is a couple that's in their mid 40s. And so the question is, okay, what's the taxes going to be like in retirement? So step one, let's look at this. They've got $400,000 of income. So let's go to the tax brackets. What are the chances that they're going to be in a lower tax bracket in retirement? First, we have to understand, what do the tax brackets look like? So $400,000 of income, what we're looking at is, again, and I've gone over this in prior episodes, and we'll link those episodes in the podcast notes. But the way this works is the first $24,800 is taxed at 10% that they make, right? And then the next, call it $66,000 that they make is taxed at, $86,000 that they make is taxed at 12%. And you can see how these tax brackets work. So essentially the last, so 200,000 to 400,000. So the last $189,000 that they make in the year, that's the money that's taxed at 24%. So their marginal tax bracket is 24%. That's the last dollars coming into their household at the end of the year is taxed at 24%. So if they get into retirement, the only way they're going to be in a lower tax bracket is if they need less than $211,000 in retirement. And that's the gross number. Okay. So think about that for just a second. This couple would need to be saving $200,000 or, obviously there's kids involved here as well, but $200,000 that can be recouped. And like, is their lifestyle actually 200? The chances is not very high. I'm not saying that it doesn't exist. It might, right? If the couple was only making 250, now they actually might be in a lower tax bracket, and that would jump them down to 22%. And that's just if all of their money is taxed in retirement, which is the next part of this. When we look at stuff and we look at where we've been putting money, let's take a look at where they've been putting money and what that looks like. So again, they've got $900,000 in, actually it's 1.2, I apologize, 1.2 million in pre-tax accounts. They had $75,000 in savings, and they had $500,000 in investments. So we see this all the time. This is where they've been putting money, right? $47,000, they maxed out their retirement plans, and they've been putting $10,000 a year into their investment account. So when we look at their income stream in retirement, so imagine fast forward, they're 44 right now, fast forward to age 65, how much of their money will be taxed fully, how much of their money will be partially taxable, and how much of their money will be non-taxable. Well, if they're putting the vast majority of their money into pre-tax accounts, this is how that pie chart looks. You can see the majority of their wealth, when they distribute to themselves, is going to be fully taxable, 67%, almost 68%. And they've got $575,000 in partially taxable, meaning not all of that money may be fully taxable. Some of it might be partially taxable. Fast forward in the future, right? When we look at this now, let's now move them to 65. What's the future tax allocation look like? So now you can see what happens here. The red gets bigger. Why? Well, they're putting more money into that and rate of return is occurring. So now 73% of their portfolio is going to be fully taxable when they turn it on the income stream. And only 26% of their income stream is partially taxable. So when we look at this, and going back to what we were just talking about, the tax brackets, the chances of this couple being in the lower tax bracket in retirement isn't high. It might occur. I'm not saying it won't, but it isn't high. And frankly, they don't have a lot of control because they chose to defer the tax. When you turn on that income stream, it's going to be partially taxed or it's going to be fully taxable. So now imagine they did something like this where they stopped putting $47,000 into the pre-tax account, and maybe they're doing $47,000 into their Roth 401k. Roth 401k is after-tax dollars that goes into a retirement plan. It grows tax deferred. And then if you pull it out past age 59 and a half, that income stream is tax-free or non-taxable. So now when we look at this, now look at their future tax allocation and look what's occurred. Now their fully taxable asset has gone down to 49%. Partially taxable is down, still at 26. That still remains the same. But now they have 24% sitting in non-taxable. When you have this type of tax diversification, now you can do different things like this. So now if we go and we go back to those tax brackets, right? Here's scenario one, right? And let's just say they only needed $300,000 in retirement. So $300,000, if it's all pre-tax money, what that looks like is they're still in the 24% tax bracket. But imagine they want $300,000, but because they have tax diversification, they can pull it from different buckets. Maybe they can go down to, I don't know, $200,000 of it is actually taxable. And now you can see they're actually at a 22% marginal tax bracket. But more importantly here, look at their effective rate. They went from 19 down to 11. It's a huge tax difference. And so in summary of today's episode, and the big takeaway is, when you're looking at where you're putting money today, or if you're about to retire, you may have already made these decisions and maybe you need to be looking at Roth conversions or really understanding the taxable, like the net after tax of the income stream. This is why it's important. It's not just the accumulation phase that you should be focusing on. It should be accumulation, but also, are you having diversification on the tax side of stuff so that you can have the best net after tax income in retirement that you possibly could want? So I hope this episode was valuable for you. Again, the takeaways from today's episode is making sure you're understanding that what tax diversification you have when it comes to turning on the income stream when you retire. Not always assuming that pre-tax is better, not always assuming that Roth is better, understanding what it looks like for you. Don't wait until retirement to address the tax situation, and always think about diversification. This is a key thing. So make sure you head over to builtforlifenotjustwealth.com. And at the top of the page there's a comment section that you can ask us any questions. Or if you want to watch the video, you can see the video to today's episode on that website. Look, we started this podcast to help you think differently about your money, and more specifically, help you think about your future, so much so that it impacts your present. Hope this episode was valuable for you. Make it a great day.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
8750025.1, expiration date February 2028.